Hey everyone, welcome back to the channel. Today, we're diving deep into a comprehensive analysis of Centessa Pharmaceuticals, ticker symbol CNTA, a clinical stage biotech company that's been making some serious waves lately. Whether you're a seasoned investor or just curious about the biotech space, stick around because we're going to unpack everything from financials to future potential. Let's get started. So first off, why are we talking about Centessa? Well, this company is in the healthcare sector, specifically in biotechnology, and it's focused on discovering and developing innovative medicines for patients with unmet medical needs. They've got a pretty intriguing pipeline, and with recent news like a massive acquisition deal with Eli Lilly, valued at up to $7.8 billion, there's a lot to discuss. I'm excited to break down what this means for investors like you and me. Let's start with a quick overview of who Centessa Pharmaceuticals is. Based in Altrincham, United Kingdom, Centessa was founded in 2020, so it's a relatively young player in the biotech game. Despite that, they've built a robust portfolio targeting a range of conditions, from narcolepsy to autoimmune diseases. Their registrational pipeline includes drugs like Serpin-PC for hemophilia and LB101, a PD-L1/CD47 lockbody for solid tumors. What's unique about Centessa is their asset-centric model, which allows them to focus on specific high-potential programs while minimizing the risks of traditional biotech development. With just 77 full-time employees, they're lean but mighty, led by CEO Mario Alberto Accardi. Currently, their market cap sits at around $3.7 billion, with a stock price of $27.58. That's the snapshot. Let's dig deeper into the numbers. Moving on to revenue, Centessa's story is typical of many clinical-stage biotechs. They're not yet generating consistent sales from commercialized products, which is reflected in their financials. In 2024, their full-year revenue was reported at zero, though they did record about $6.85 million in 2023, likely tied to collaboration or milestone payments. Historically, back in 2021, they reported $200 million tied to their product Lixivaptan, which was a significant one-off event. Right now, their focus is on R&D, pouring resources into clinical trials rather than revenue generation. This isn't unusual for a company at this stage, but it does mean cash burn is something we need to watch closely. For investors, the real revenue story will come if and when their pipeline candidates get regulatory approval and hit the market. Now let's talk earnings, or more accurately, the lack thereof. Centessa is still in the red, which, again, isn't surprising for a biotech in the development phase. For the full year 2024, they reported a net loss of about $235.8 million, translating to an earnings per share of negative 206 cents. Compare that to 2023, where the net loss was $151.1 million, or negative 157 cents per share. The trend here is clear. Losses are widening as they ramp up investment in their pipeline. Operating income for 2024 was a loss of $201 million, and EBITDA came in at a negative $221.9 million. These numbers highlight the heavy R&D spend, but they also show the company's commitment to pushing their candidates forward. The key takeaway? Centessa isn't profitable yet, but the potential payoff could be huge if their drugs succeed. Let's take a closer look at Centessa's financial health through their balance sheet and cash flow statements. As of the end of 2024, they had a solid cash position of $383.2 million, with total current assets at $536.4 million. That's a comfortable cushion for accompanying cash on clinical trials. Total assets stand at $576.8 million, while total liabilities are $175.3 million, giving them a stockholders' equity of $401.5 million. Their current ratio is an impressive 10.57, showing they've got plenty of liquidity to cover short-term obligations. On the cash flow side, operating activities used up $142 million in 2024, which is consistent with their R&D focus. However, they raised $364.8 million through financing activities, likely tied to offerings like the $250 million public offering of American Depositary Shares announced in November 2025. Free cash flow was negative $142.1 million, which isn't ideal, but with their cash reserves, they've got runway for now. Debt to equity is low at 0.39, so they're not overly leveraged, which is a plus. Overall, Financially, they're in a decent spot to keep pushing forward, but managing that cash burn will be critical. All right, let's talk valuation. Centessa's current market cap is $3.7 billion, with an enterprise value of around $3.93 billion. Their price-to-sales ratio is sky-high at 257.9, but that's because revenue is minimal right now. Price to earnings? Well, it's negative at 9 of 15.87 due to those ongoing losses. Looking at their beta of 1.55, the stock is more volatile than the broader market, which is something risk-averse investors should keep in mind. When we think about valuation in the biotech space, it's less about current earnings and more about future potential. With the Eli Lilly deal valuing Centessa at up to $7.8 billion, or $38 per share, the market seems to be pricing in some serious upside if their pipeline delivers. For context, the biotech industry average PE is around 82.26, so even when Centessa turns profitable, there's room for growth if they execute well. My take? The valuation looks speculative, but justified given the pipeline and deal activity. Now let's break down Centessa through a SWOT analysis to get a clearer picture of where they stand. Starting with strengths, their solid financial position is a big one. With over $383 million in cash, they've got the resources to fund their clinical programs without immediate pressure. Their innovative pipeline, especially in areas like narcolepsy and hemophilia, positions them in high-demand therapeutic areas. On the weaknesses side, the lack of revenue and ongoing losses are obvious concerns. They're burning cash fast, and if trials fail or get delayed, that could hurt. For opportunities, the $7.8 billion Eli Lilly deal is a game-changer, signaling strong industry confidence in their sleep medicine assets. Plus, their expansion into neuropsychiatric indications with orexin receptor agonists opens new markets. As for threats, biotech is inherently risky. Clinical trial failures, regulatory hurdles, or competition could derail progress. There's also the broader market sentiment around biotech stocks, which can be volatile. So while Centessa has a lot going for it, there are real risks to navigate. Let's check out Centessa's recent stock performance. Over the past week, the stock is up 0.86%, and over the last month, it's gained 6.89%. However, the 3-month performance shows a drop of 11.4%, which might reflect some market uncertainty or profit-taking after earlier gains. Looking longer term, the 6-month return is a strong 41.78%, and over the past year, it's up 46.27%. That's solid growth compared to the broader biotech industry, which is up 55.8% over 1 year, but only 44.9% over 6 months. The 5-year return for Centessa is 12.64%, though as a newer company, that's a shorter track record. On the chart, we can see the stock has momentum, but that 3-month dip suggests potential volatility ahead. For short-term movers, keep an eye on news catalysts like trial updates or further deal developments. Finally, let's touch on intrinsic value. Given Centessa's stage as a clinical biotech with no consistent revenue or profits, traditional discounted cash flow models are tricky to apply. Their value lies in the potential of their pipeline and partnerships, like the Eli Lilly acquisition. Instead of a strict DCF number, I'd frame their intrinsic value around industry comps and deal metrics. The $7.8 billion valuation from the Lilly deal suggests a per-share value of $38, significantly above the current $27.58. If their key programs like SerpinPC or LB101 hit milestones, that could justify or even exceed this figure. So what's the takeaway here? Based on the deal value and pipeline potential, Centessa could be undervalued at $27.58, compared to the $38 per share implied by the Lilly acquisition. However, this hinges on execution. Any pipeline setbacks could erase that premium. For long-term investors, the risk-reward looks compelling, but it's not a sure thing.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.